All right. So as I said, when treating this topic, there's a question. You are going to prepare the account of a sole trader. So this is the question. When it's presented before me, the first thing to do is to write the name of the entity, which is this. Nsa Zoko. Sorry. So I write it here. Nsa Zoko. After that, the next thing is I would go to the requirements. What am I to do? On the next page, we have the requirement here. The requirement says, here, I'm reading from here. I'm reading from here. I'm reading that requirement. It says, prepare a statement of profit or loss for the year ended 31st December 2020. So I was then, in my answer booklet, I'll start writing from here. Statement of, so A, statement of statement of so A, statements of profit or loss for the year ended 31st December 2020. So all that I just did was to copy what is there, That's a statement document. It says, A, prepare a statement of profit or loss for the year ended 31st December 2020. Then in my answer booklet, I'll record statement of profit or loss for the year ended 31st December 2020. Now, one of the things we have to take note of is that we have Alice, which we are going to discuss right now. We have Alice, which we are going to discuss of right now. So after the entity's name, after the title, the next thing is we have to go and read the trial balance. What we are seeing here is called trial balance. This is called the trial balance here. It says the trial balance was extracted from the books of all these from here. From here to the end here. That is the trial balance. And always the trial balance figures, I'm using green. The total debits should be the same as the total credits all the time. All the time they should be the same. Total debit should be the same as total credits. And this side is called the debit side. DR for debit. The first Ghana cedi sign. The second is called credit, CR for credit. All the time. So, and what is here is called additional information. I'm underlining in green. It's called additional information, or sometimes called the footnotes. It's called additional information or the footnotes. So, in trying to understand what this trial balance is, these trial balance, which are in the red square or rectangle, they are values or they are figures from the beginning of the year. So the trial balance information refers to information from the beginning or at the beginning of the year, or within the year or during the year. Let me put it that way. Then the additional information, the additional info, which is also known as the footnotes, they are end of year figures. End of year figures. They are end of year figures or closing balances. Or closing balance. We are going to use both of them. So please be keeping the notes because you'll be needing them. Another thing is that or let me write in the notes here. Another thing is that so the trial balance information are at the beginning of the year figures. At the beginning of year figures. And the footnotes or additional information are end of year figures. The footnotes are to either increase, add to, or subtracted from the trial balance figures. So the footnote figures, the footnote information, the additional information in the footnote, they are either to be added to or subtracted from the trial balance figures. And whenever we are adding to or subtracting from, it is called adjustments. It is called adjustments. So we are going to construct adjustments when it comes to the additional information. For the trial balance figures, we are going to use them. Also, the trial balance figures, they appear once. They are treated once. So trial balance figures, treated once. P&L, either they will appear in the P&L or the balance sheets. So trial balance figures are treated once. Either it appears in the P&L or either they appear in the P&L, which is a profit or loss statement, or in the financial position, which is called the balance sheet. But the additional information figures or the footnotes, they are treated twice. They will appear in the profit or loss and the balance sheets. So these are some of the things we have to know. The additional information figures, which is also called the footnotes, are going to be treated twice. Treatment mean they are going to be posted twice in the P&L and the balance sheet. But the trial balance figures, some will go to P&L. Those which will go to P&L, they will not appear in the balance sheet. And those which will go to the balance sheet, they will not be treated in the P&L. So you have to note that. Another thing else is called ALICE. ALICE, as a theory, is called the elements of the financial statements. What are the elements of the financial statement? A stands for assets. L stands for liabilities. I stands for income. C stands for capital. E stands for expenses. So accounting basics, or accounting basically is derived from what is called transaction, or an accounting takes place when transaction takes place. So if accounting takes place when transaction takes place, the ALICE will put the A and the E on the debit side. So here in accounting, we say that from this horizontal line, the tip of the horizontal line to the center, downwards on the vertical line, it is called the debit side, the left-hand side. Then from the tip of the right hand horizontal line to the center downwards, or the vertical line upwards to the right, it is called credit side. And in the middle, between the debit and the credit, in the center, we write the name or title of the account. So the Alice, the capital A, the first and the last letters go to the debit side. The middle letters, LIC, they go to the credit side. They go to the credit side. Now, on the debit side, we record expenses or cost. Anything cost goes to the debit side. Anything losses or loss goes to the debit side. When we go to the credit side, so the debit side, we have assets and expenses, which are from the Alice. The two from the Alice go to the debit side. Anything, expenses, cost, loss, they are recorded on the debit side. Anything liability, which is the L, goes to the credit, like loans, long-term loans, finance leases. We talk about leases or finance leases. We talk about bonds, debt. They're on the credit side. Then the I talks about income, and also we write gains. Any gains, any profits, they are recorded on the credit side. Then the capital, we write capital or equity. So in accounting, we have what is called recognition and measurements. Recognition, let me say simply that it is recording, but technically we say it is talking about incorporating a transaction, right, into the financial statements when they fall under one of the 5 elements of the financial statements. That is when they fall under the Alice. So we say you are recording the transaction to fall under one of the 5, which is the Alice. So recognition, when I say I'm recognizing it, so it means I'm recording it under one of the 5. So whatever the transaction is, it must fall under one of the 5. It might be an Alice, it might be an asset, liability, income, capital, expenses. Then measurement talks about we are costing or valuing that item you have recorded. So assuming the business bought a building. This building, under which of the elements of the financial statement does it fall under? It falls under asset. It's an asset to the business. That is, if the business is going to use it, it's an asset. So that building the business bought, you have recorded it as an asset. Now, what is the measurement? What is the cost? The business bought it for 200,000 is the cost. So I've recognized that building transaction under the Alice recognition, and I have measured it. I have valued it. Please, are we okay? Please, are we okay?
Yes, yes, please.
Okay. Lillian, are we okay?
Yeah.
All right. So please pay attention. Now, so I'm done. What it means is that as we are looking on the left, as we are looking on the left, as we are looking on the left, all the items, I'm using red, oh, I'm using pink, all the items on this side, all the figures on this side, with their corresponding ledgers. This land equipment accumulated, they are all called ledgers. With their corresponding ledgers, which are on the debit side, I'm using DR. They are all either assets or expenses. So long as they are on the debit side, they will fall under either assets or expenses. And expenses, we have 3 categories of them. We have the expenses, cost, loss. So every item on which has a figure on the debit side, it is falling under asset, expenses, or the cost or the loss. It's falling under either of the two. If the item is on the credit side, I'm using black here. If the figure is on the credit side with a corresponding ledger, it means that that figure on the credit side with its corresponding ledger, it's either a liability, it's either an income, it's either an equity, one of them. Or is either a liability, bringing income, a gain or a profit, a capital or an equity item. That is the items on the credit side. So I'm going to go through, or before I start, here's my work. This is what I want to do. This is what I want to do. I want to prepare financial statements. That is what I want to do. So if I want to prepare the financial statements, I need to first analyze the transaction. I need to first analyze what I'm going to do. And when I analyze what I'm going to do, then I'll start with my work. That is what I'm basically trying to say. So now all that we are trying to do is that we are trying to understand what the financial statement is about. We want to understand what the financial statement is about, or our work is about. And you can do all this in a microsecond. Because I'm teaching, I have to explain, so it's taking time. But however, I can do this within a microsecond and everything will be fine. So every item on the list. So now let's go through the items. Let's see. Land. Land is an asset to the business. So you could see land is an asset. So it's on the debit side. 25, 2,000, 250, 1,200. Equipment is also an asset to the business. So it's also on the debit side. Accumulated depreciation is a liability. We call it provisions. They are not liabilities which are actual cash values, but they are provided for. They are estimated. So it's treated as a liability on the credit side. We have inventory. Inventory is an asset. Inventory is an asset. We can also treat inventory as an expense. It is also on the debit side. We have receivable and payable. Whenever we see that an item like receivable and payable, they're on the same row. Those two are placed on the same row. The first name, which is the receivable, will take the first figure. And the second one will take the second figure. Please, do we get it? Please, do we get it?
Yes.
Yeah.
So receivable here is an asset. It's on the debit side. Payable is a liability. It's on the credit side. Okay. Valued added tax refund. Here, value added tax refund, it's a gain, right? So mostly we will say it's a current asset. The business would refund to the business an amount of money. It's due. So we would say that it is an asset to the organization. So value added tax refund is an asset. So we'll keep it under current asset when we get there. So deposits on rented premises. Deposits means it's an asset to the business because the business has kind of paid in advance, right? They have made a deposit on a rented asset. It is not due. How do you know it's not due? They've made a deposit on the rented premises. They made a deposit, like payment in advance. So it's deemed something like a current asset. So it's an asset. Bank and cash is an asset. Allowance for doubtful debt is also like a provision. So provisions are like liabilities, just like the accumulated. We have tax liability. We can see from the name liability. So it's on the credit side. Business rent. Rent is an expense. So you could see rent on the debit side. Sales will bring income. Income is on the credit side. Purchases is an expense, debit side. Returns. Returns, we have two types. We have the returning it in, and we are returning it out. So definitely, one of them is an expense. The other one is a gain. The one on the right is a gain. Sorry. Return inwards, I was thinking about discount, sorry. Return inwards and outward, they are used to adjust against sales. So for example, I'm using this. The business sold this money, this amount of money, or sold goods for this worth of money. And some customers brought items back to the business worth this 8,300. So for me to find the actual sales sold, I'll deduct this figure from the 804,500. And the returns outwards is the opposite one also. So if we see returns, one is used against sales, the other is used against purchases. So sales is on the credit side. We will match it against the returns on the debit side. Purchases is on the debit side. We will match against the returns on the credit side. Purchases is on the debit side. We will match it against the sales on the credit side. So that's how they are used. Now, discount too, we have two types. We have the discount allowed, we have the discount received. They always know for one. Discount received is the gain, is the one which is bringing gain, money in. And discount allowed is the business is losing money, losing, right? It's a loss. So when we get that, I'll explain it better. So just know for one. One is a gain, credit side. One is a loss, debit side. Distribution and advertising, 8,900 is an expense. Power, that's electricity, utility expense. Communication expense. Insurance is an expense. Wages and salary is an expense. Employer social security contribution is an expense. 4% long-term loan. It's a liability, long-term loan liability. We have long-term loan interest. It's an expense, but we treat it other way. Bad debt is an expense, debit side. Drawings is an expense, debit side, but it's used in another way. Retained earnings is an equity item. So I said here, we record capital or equity. We have capital itself. It goes to the credit side because capital and equity goes to the credit side. Then we have suspense. This suspense is recorded on the credit side. So we could see that they balance, both sides balance. That is why it is called trial balance. Debit and credit must be the same. This side is called the credits. So you do all these checks before you start your work. You go through all of them, examine the figures. Now, let us go on. What I just did was confirm that all the transactions in the trial balance fall under one of the five. Because without the one of the five, without the five, we can't prepare financial statements, which is the profit or loss, balance sheet, cash flow. We cannot prepare all of them without the ledgers in the trial balance falling under the five. We cannot prepare it. And I've used that with the T accounts for all of us to see. Okay, so you do that before you start your work. Now, the next thing to be done. This is something which is very crucial. So after noticing all these, the next thing is you use a ruler and you match. You match. You go with a ruler and you match all your ledgers against their corresponding costs. So let's say I'll match land to this to this to this. You match them. Why? Because you are in exams conditions or under other conditions, things are really quick. We don't have so much time to think about where this one is, where that one is. So use ruler to match them. Use ruler and a pencil, don't use a pen, to match all the figures against the items here are called ledgers. You match the ledgers against the figures, corresponding figures. That's what we do for all of them. You do that. Then let's go to the additional information, which is the footnotes. As we said from here, the footnote is to provide what? Is to provide adjustments. The footnote here is to either add to or subtract from the trial balance figures. So one of the things we do is we would say additional information I. The inventory count as at 31st December 2020 showed using inventory value at 42,390. So what it means is that I'll go to my trial balance. Means that when I get to inventory in the trial balance, which is the opening inventory, I'll write note 1. Meaning when I'm solving and I get to inventory in note 1, there is a corresponding information of that inventory in the trial balance, in the additional information here. Then I'll go to Insanzoko has agreed an annual rent of 40,000 annual rent. Go to the trial balance. Where is rent? This is rent. So footnote 2. That is it. Then I come to III, including insurance above is an amount of 18,000 paid to insurance, paid to insure the equipment. The policy year ends 28 February 2021. So III is talking about insurance. and there's also insurance in the trial balance. So I remember additional information items are to add to or subtract. So the insurance figures here, he said I'm going to the 18,000, I'm going to make some adjustment to it and add to the 22,500 or subtract from it. Then we go to Insight of Court has a specific concerns over 5,120 of receivables balance and wishes to set up a specific provision. So here it's on receivables. So these receivables, it says general provision. We usually refer to it as provision for receivables. And this IV, it is linked to this one. When we get there to, I'll give further insights. But for now, let's accept the IV. So I'll write it against it. IV. So that is it. Let's look at the next page. So the next page says, so it's a remaining receivable balance, which is just remaining receivable. Let me clean this. It says remaining receivable balance should be at 5%, which is still on the IV, the provision for receivables. Depreciation is to be charged as follows. Land, no provision, equipment, 15% reducing balance method. So this IV, when I go to, is depreciation on land and equipment. So when I go to, it's V. When I come to land here, land, I write V, right? I write V for land. So I write V for land. Then also V for equipment because the depreciation is on both of them. Okay, that's what I'm going to do. Then I go to the next one. It says depreciation should be calculated to the nearest whole number. So I shouldn't even leave any decimals in the depreciation figure. Now, VI says the suspense account balance above relates to sales of 1,200, which was recorded as purchases in error. So it means that the sales figure of VI, it has an issue with as well. So when I get to the sales figure, I write VI. Why must I be writing all these? I must write them because of the time factor during examination. That's when I get to sales, and before I record the sales figure, I need to go and give attention to the VI information on the sales. And what do we say about the footnote items? They are either to add or subtract. So the VI information in the sales is to either add to this sales figure or to subtract from it. So I cannot ignore it. All right. So the VI says the subsequent account balance above relates to sales of 1,600, which was recorded as purchases in error. So purchase is also affected. So VI will have purchases also. We're talking about purchases as well. So we'll say purchases. Where is it? Purchase is also affected. VI. VI. Also purchase is also affected. VI. So now let's see what I've finished with. And we need to do all this before we start work. Required. So it means it says that receivables and payables balances are correct. Good. So it means I wouldn't touch the receivables and payable balances. I'll not touch them. The receivables and payable balances, which are these, they are accurate. I did not touch them. The figures are okay. So we do all this. And we do all this before we start the work. So now let's start the work. We are going to prepare 3 levels of profits. We are going to prepare 3 levels of profits. So in exams, you can write it on the question paper, the 3 levels of profits you are going to prepare. So 3 levels or 3 categories of profits. We are going to find what is called the gross or gross profits. How do we find a gross profit? We will say it is the sales minus the cost of sales. The second one is we have to find total income. Total income equals what is the gross profit? So let me use GP for the gross profit. So the GP is the gross profits. We will add other income. Then the third level of profits, it is called net. This is what they actually want us to find. That's where the profit or loss statement is about. The last level of profit. Net profit or loss. Now, I'll bring in the total income here, which is the TI, total income, our less operating expenses. So the question wants me to find the last level of profit. But before I find the last level of profit, I must go through two initial or earlier profits, which will lead me towards the last profit. So the statement of profit or loss is on the last level of profit. However, I need to start first finding a gross profit, find the total income, and both of them previously will lead me to find a net profit. So these are the three levels of profits we are going to, or categories of profits we are going to work on before we prepare the statement of profit or loss. Now back to the Alice. So for this one, you can just write it somewhere. The categories of profits. We can go with the acronym GTN. Find the gross profits, find the total income, find the net profit. So GTN. Okay. GTN. So you can say, let's say GTON. Yeah, GTON will be fine. GTON, gross profit, total income, net profit. So GTON. They are all profits. You can even say gross profit, total profits, net profits, or gross profit, total income, and then what's the name? Net profit. Or you can go with G10. G10, a 10, 10 of tomato. So gross profit, total income, and then net profit. The three levels of profit. First, second, third. G10, gross, or you can say gross 10. Gross is the gross profit. Total income, TIN, and the N is the net profit. One of the things I wanted to explain before we start is this. Of the Alice, right? Of the Alice, which is the AIL, Alice itself, this Alice, we are going to use the I and the E, I and E, to prepare the P&L statement, profit or loss statement. So when we pick the I, it's income, we will take out expenses. That's what we have here. That's what we have here. Sales is an income. Then we'll take out expense, which is cost of sales. Then we'll get the first profit. So we are just doing income, expense in the P&L. And it's from the Alice. We are taking just I and E to prepare income statement. So everything income, we'll take out everything expense, we get the profit. Then when it comes to total income to gross profits and income, we are adding more income. So we have total of the two. Then when it comes to the net profit too, we have the total income. Then we are taking out expenses for us to get the net profits. So from the Alice, we are taking the I and E to prepare it. So now let's go. We are about to start. What is the first level of profits I need to prepare? Gross profit. Good. So to find the gross profit, what do I do? Yes, someone should help. Good. So sales. Let's go. Let us go and find the sales. So I can write two workings here. Let me say debits, Ghana cedis. Okay, debits, and I write here as credit, Ghana cedis. So I'll first begin with the sales. What's the sales figure?
804,500.
Come again.
804,500.
Okay. So the sales figure from the trial balance is somewhere here. 804,500. So let me write the figure. 804,500. Remember that we wrote some adjustments against it. We wrote some value, some footnote number against it. And the footnote number we wrote against it was VI. VI. Meaning that the VI had something to say about the sales figure. The VI had something about the sales figure. So let's go and watch what the VI says. VI says The suspense account balance above relates to sales of 1,600, which was recorded as purchases in error. So what do you think we are going to do? Yes, what do we do? The suspense account we have in here, it's they wrote 3,200 because of double entry. Okay, so it says that the suspense account figure here, it was recorded in it as 1,600. Value for sales, which was recorded to purchases, or which was recorded in purchases. So what do we do? How do we correct it? The figure is for sales, but they recorded it in purchases. What do we do? Yeah, we'll subtract from the purchases and add it back to sales. So we have the sales figure, original sales figure. Then we will say add sales, right? Or add sales in error. So let's say add sales in error. What is the sales in error? 1,600. Please, are we getting it? Are we getting it? Or we can say, we can go by this. Sales into brackets 804,500. Then we'll add the one in error. Then we'll write the total sales here. Which one do you prefer, the first method or the second method? Which method should we go with? The first one or the second one? Oh, let's be quick. Which method do we go for, the first one or the second one?
Second.
The second. Okay, so let's go with the second. Because the sales was in error, we will add both of them together. So let's go. So sales into brackets 804,500 plus the 1,600. They sold, by instead of recording it under sales, they went to record it under purchases. So there's 1,600 in purchases does not belong to purchases. It belongs to sales. So we have to add it. Then when we get to purchases, we'll subtract it from there. So what do we have? What's the total? What's the total? Now, this is what we have done. 806100. So we ask ourselves, this sales figure we have recorded, is there any other thing else in the trial balance that affects the sales? Yes, returns. This one. Returns, this. I told you whenever there is a returns, these returns affect both sales and purchases. And if the sales is on the credit side, you will go for the returns, which is on the debit side. Another thing else I should explain. Please watch. When we come to the Alice here, if I have an asset, let's say motor vehicle, and I buy additional motor vehicle, I buy one more motor vehicle, because motor vehicle is an asset and it's on the debit side, I will add the next motor vehicle to the existing one, or to the original one, or to the initial one. If there is an expense, utility, this month the business spent 200 cedis on utilities. Next month the business spent 200 cedis on utility. The first month 200 cedis, I'll record it on the debit side because it's an expense. The next month utility of 400 cedis, I'll come to the debit side of that expense and record it there. So what am I doing? I am adding. The same with liability. If I bring another liability, I'll add. Income. If I bring another income, I'll add. Whether it's an income gain or profit, I'm going to add. Equity. If I bring more equity, I'll add. But when they switch sides, let's say a liability item moves to the credit side, a debit item moves to the credit side, it will go and subtract. When a credit item moves to the debit side, it will go and subtract. When they change size, they will subtract. But on the same side, they will add. When they change size, they will subtract. Please, do you understand this?
Yes.
So let's go on. So sales, that's what we have here. So as I said, the sales figure here, which is the 1,000, 8,400, 500, it is always adjusted with the returns. The returns. Both the sales and purchases are adjusted with the returns. Both the sales and purchases, they are adjusted with the returns. So if I have a sales figure, and the purchases, they are all adjusted with the returns here. They are all adjusted with the corresponding returns. So when I have 8,400, I'll pick the returns on the opposite side. It simply means, as the business is, if you sell 400 cedis worth of goods to a customer, sales, and the customer returns 50 cedis worth of goods that this worth of goods are spoiled, how much did you actually sell? 350. So this 50 cedis here is a return. You are returning it inwards. Since it's coming in, it's on the debit side. Sales is a credit, it's an income, it's on the credit side. So because the debit returns of 8,300 is because the debit return of 8,300 is on the debit side, and we are moving it to the credit side of sales, will that returns figure be positive or negative on the credit side? The returns figure here is a debit item, and we are going to use it against sales, match it against sales, and say it's on the credit side. So when you move the debit side figure to the credit side, from what I just explained, will it be added to the sales or subtracted from the sales? Subtracted because it is changing sides. That's why we say less return inwards. Another name for the return inwards is called sales returns. How much is this? 8,300. We'll less it. Are we good? So let's go. Less return inwards. 8,300. Why? Now, the point is that in exams, most of these ledgers, which are from land to suspense, they would be featured in the exams. So we should know how to treat them. That whenever there is sales, we know where it comes to. Whenever there is returns, and they write return inwards, or they write returns as it is here, or they write sales returns, we should know how it's treated. That's the most important thing. So what's the difference? How much did the business actually sell?
7,700.
7.
9,700.
This name here, this figure, its name is called net sales. So whenever we say net sales, net of something, in accounting, in finance, it simply means that the word after the net, something was taken from it. The word after the net is a certain figure. Something was taken from it. The balance is called the net of that word. So if I have net sales, it means sales was a figure, was the original figure. Something was taken out of it. So sales was the original figure. Something was taken out of it, which is called return inwards. The balance on the sales, which is the 7,978,800, it is called the net sales. Please, you understand it?
Yes.
So when you say net profit, it means there's a bigger profit somewhere, a gross profit somewhere, a huge profit somewhere. They've taken out something. The balance after taking out whatever they took is called the net profit, net income, net export, net imports. They all mean the same thing. Now, after the net sales, what is the next step? So we first had to calculate for sales. But because the sales figure had adjustment, we had to go and reflect the adjustment or effect it. So we effected the adjustment on the sales. So now we've gotten net sales. What is the next? Cost of sales. Cost of sales is an expense. So in the T account, which we have at the top here, where do we record expenses?
On the debit side.
On the debit side. But because you are going to match the expense against the sales, sales is a credit item. CR. Cost of sales is an expense, it's a debit item. But if you are moving the cost of sales to match the sales on the credit side, will the cost of sales be positive or negative?
Negative.
That is why we are subtracting. So when it comes to the sales, we say less. Why are we less and subtract? Subtract cost of sales. But this cost of sales guy here is a collective cost. Means that there are different other costs under the cost of sales. So now we start. If the business is beginning, if the entity is beginning a business operations in a new year, it will begin with the opening inventory. This opening inventory was the closing inventory for the previous year. We are dealing with the year 2020. So if the business at the end of 31st December 2019 at 11:59 p.m., the worth of goods, 11:59 p.m., the worth of goods in its shelves or in its storeroom or whatever was, let's say, 1,000 worth. That's the value of the goods. When it gets to 1st January 2020, at 12 a.m., that is just one minute difference. 12 a.m. at 31st December 2019, this 1,000 is called closing inventory because that was the number of inventory it ended the year with, or the amount of inventory it ended the year with. On 1st January 2020 at 12 a.m., will the business start its operations with 1,000 worth of goods or more or less? Yes.
It starts with 1,000 worth of goods.
Thank you very much. It will start with 1,000. So for at the date of the 1st December 2019, it's called closing inventory. But on 1st January 2020, this same 1,000 is now called opening inventory. So what I'm trying to say is that in the trial balance, I told you it takes beginning of the year figures and during the year figures. So the inventory we are looking at, this inventory figure we are looking at here, is an opening inventory value. It is not a closing inventory figure. So we will write it as opening inventory. That's what the business began with. That is what the business began with. So that's what I'm explaining everything. So it will take some time before we finish. So that in the examination, wherever we see or find the figures, we'll know where to post them. So opening inventory is now 49,620. That's the opening inventory. Another question is, if the business began with 49,620 worth of goods in 2020, is this the total worth of goods it will sell throughout the year till the year ends? Hello?
Oh,
So what will the business do? You begin a business, you are starting your operations, or you buy and sell. And then at the beginning of the year, you start with 49,620 worth of goods in your shop. Okay. So is this the only worth of goods you sell throughout the year for the whole 12 months?
no.
No, what do we do? But if you sell this worth of goods, won't they finish? They will finish. So when you sell this worth of goods at the beginning of the year, they will finish entirely. So what we do is that we buy some to replace what we sell. Because the sole trader is a buying and selling activity it does. So we will have to replace those we will sell. Otherwise, 49,620 worth of it cannot last the entire year. So the next thing is we go on to purchases. You have to restock. That is purchases. So when we are doing the purchases, look at the figure of the purchases in the trial balance. The figure is 390,200. And don't forget that we wrote a footnote against the purchases, which was the VI. So let's go and check what the footnote in the VI says. It says the suspect account balance above relates to sales of 1,600, which was recorded as purchases in error. So it means that this 1,600 we are looking at here was added to the purchases. So when we prepared the statement, we added back the 1,600 to the sales figure. So this 1,600, what did we take it out from? We have to take it out from purchases, where it was wrongly input. So now, what is the purchase figure here? 390,200. Then we will less the sales figure in error, which was recorded in purchases, which we have sent to sales. Yes, what do we have? 3. That's what we've done. Now, the next thing is that whenever we are solving and we see return inwards, definitely we said returns, they affect both sales and purchases. So if the two returns, one is affecting sales and we've used one, the same returns here, then it implies that the next one will affect purchases. This second returns. This one is gone. We've used it against sales. Then the next returns here, we are going to use it against purchases. We use this one against sales. We are going to use the 7,500 here against purchases. So the sales returns on the left, the sales returns on the credit side. When we bring it to purchases, to match it against purchases, is it going to add or subtract? Yeah.
Can you go over the purchases?
Now, purchases is saying that the business sold 390,200. And from the footnotes, IV, remember we wrote footnote IV against it. Why do you write footnote IV against purchases? Because the footnote VI says that the suspense account balance above relates to sales of 1,600. So there is this suspense account here. Here, the last figure. And that's this suspense account. And this suspense account relates to a figure of 3,200, which relates to the sales, right? So the suspense account balance above relates to sales of 1,600, which was recorded as purchases in error. So it means that there's this 1,600, it is sales, but then it was recorded as purchases in error, meaning they have recorded it under purchases in error, meaning like there's a double entry. They've taken 1,600 in purchases, which is debited, and they've credited suspense with 1,600. So you know that in account you do double entry. If you debit one account, credit the other account. So here they debited purchases and they credited the suspense with 1,600. And the question is saying that the footnote is saying that this 1,600, which is for purchases, it shouldn't be for purchases. It was rather sales, but they erroneously recorded it for purchases. So what must we do? Because sales is an income, pay is an expense. If we include the 1,600, the 1,000 included in the purchase figure of 390,200 cedis has caused the purchase figure to increase. Meanwhile, this 1,600 is an income to the organization. It's not an expense. So the best thing is we have to reduce or subtract the 1,600, which is the sales figure from purchases, and post it to purchases. So we are just doing what is called reversal. We are crediting the purchases account, right? And we put it to where it belongs. That's all. So we are just reversing it. They've added it to purchases. It shouldn't be there. So just subtract it and post it to where it belongs. Purchase is an expense account. They've brought in income. So take out the income and send it back to the sales so that it will increase the sales and rather reduce the purchases. Are we okay?
Yes.
All right. Thank you very much. So please let's continue. Any other question?
But Manuel, there was an inventory figure in the footnote.
Yeah, we'll come there.
Okay.
We are coming there. So now, please let's proceed. Purchases. So as I was saying, returns, one is used against sales, another is used against purchases. So here we had the returning was used against sales. Now we are using purchases against the other one, the return outwards or purchase return. This out is going out credit side. So we'll use it. We just use them because they are of opposite direction. So purchases, the business bought 388,600. Now the returns, which is on the credit side, when it moves to the debit side, will it add or subtract? Will it add or subtract? It will subtract because it is changing sides. It's moving from one side to the other side. So we'll say less. We will say less return outwards. Less return outwards. How much is it? How much is the return outwards?
7,500.
Less means subtract. So when I take out the 7,500 from the 388,600, what figure will I have?
Then let's take it.
You have what?
3,000.
Come again.
3,1100.
381100. This figure, is it this?
Yes.
This figure here is called net purchases. Why? Because there was a purchase figure, 388,600, and something was taken out from it, 7,500. Therefore, it is called net purchases. Do we get it?
Yes.
But I'm not going to use this figure. Let me take it out. I don't want the whole work to be very long. Let me take it out. Okay, let's proceed. So let me add these. These are the only items. Assuming in the question brings what is called carriage inwards. Carriage inwards. Sometimes you will see carriage inwards and carriage outwards. So assuming the question brings in anything like carriage inwards. Carriage inwards, we will add it to the purchases. So carriage, we would have had purchases 388,600. Let's say carriage inwards was 500. Then purchases 388,600. Carriage inwards 500. Then we will less return outwards. That's how it should have been. Carried outwards, let's say carried outwards was 300. Carried outwards will go to the operating expenses. Carried inwards will be added to will go to the purchases, will be added to the purchase sales. Sorry, it will be added to the purchases because carried inwards is incurred whenever the business goes to buy something from the market. For carried inwards could be like the cost of the taxi fares, the cost of, let's say, delivery from the market to the premises of the business. So the cost of paying porters, those who will carry and help, the cost of the transportation fare from the premises of the market to or from the market to the premises of the business is called carriage inward. So we will add it to purchases. Then the carriage outwards is also an expense. You find all of them on the debit side. The carriage outwards is also an expense, but we will send it to the operating expenses. Carry outwards, meaning when the customer comes to buy and the business offers this delivery service, they're going to deliver the item to the premises of the customer. So you are carrying it outwards. It doesn't have anything to do with the purchases of items you bought into the business. But the carriage inwards to carry in. The cost you incur to carry in, bring in the goods. So assuming the question had carriage inwards, we would have added the carriage inwards to the purchases. So after the purchase of 388,600, we'll have carriage inwards 500 before we come and less return outwards. Please, do you understand it? Okay, but this question doesn't have. So we proceed. Now, let's add all these three. 49,620, 388,600, 7,500 minus 7,500. Let's do it. What do we have?
430 720
430.
720.
The name of this figure is called Kogas. It is called cost of goods available for sale. In exams, you can just write COGAS. That's all. Everyone understand? Anyone who is marking the accounting script knows what COGAS is. Cost of goods available for sale. Now, always also done for, okay. Now, the next one is called closing inventory. What is the closing inventory figure? We go to the additional information where Reverend was talking about. What's the closing inventory figure? A. What is the closing inventory figure?
The closing inventory figure is 42,390.
Thank you very much. 42,390. Please pay attention. Now that we have two inventories, this over there and that's down there. Whenever you write this, always the closing one you subtract. Always. The one which is closing you subtract. The one which is closing you subtract. The one which is opening you add. Because it's an expense. The one closing we subtract. Don't forget it. The one closing we subtract. That's it. So what do we have? Subtract the 42,390 from the 430720. 3 what? Okay. Did you all obtain this value? This figure, 388,330, it is the cost of sales. Another name for the cost of sales is called cost of goods sold, COGS. 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 Cost of goods sold or cost of sales. Now, so that figure here is the cost of sales. Don't forget, I could have written it here, 388,330. So the side where I've written the 388,330, it's the debit side, and it's good and it's positive there. Why? Because cost of sales, cost is an expense, and expenses are recorded on the debit side. So all the items under the cost of sales, which are in negatives, the 7,500, the 42,390, they are all credit items which have moved or migrated to the debit side. They have left the credit side or moved from the credit side to the debit side. That's why they are negative. But all those items which are positive, that is where they belong. They are in their home. But the visitors are the guests, are the return outers and the closing who are from the credit side coming in there. So they will subtract. So now the cost of sales is debit, it's positive. But because we have to match the cost of sales and expense with the credit item, which is sales, we will move the 388,300 to the credit side. We will move it to the credit side here. So when the debit item crosses from its side to the credit side, will it become positive or negative? Negative. That is why it said less cost of sales. Because you eventually move it to the credit side. When you move it, it's a debit, it will become negative. Please, are we okay?
Yes.
Now let's move on. So what's the difference? Na 90.
409470.
Watch. We are working on 3 levels of profit. What is the name? Have we found our sales?
Yes.
Have we found our cost of sales?
Yes.
Have we subtracted the cost of sales?
Yes.
What's the name of the figure we got eventually?
Yes. Profit.
So we are done with this. So this figure is called gross profit. Now watch. What is the next profit to find?
Total income.
How do we find the total income? How do you find the total income?
Subtract other income from your
No, 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 no. Look at the number 2. How do we find total income?
add
Just,
other
just,
income.
just tell me what you see. Just tell me what you see. Total income equals what? No.
Gross profit.
Yeah, gross profit plus other income. So do we already have the gross profit?
Yeah.
What do we have to bring?
Add other income.
Why are we going to add other income? Because in the T account, income, gains, and profits, they are all on the credit side. And whenever there is an income or gain, and you are bringing another income, gain, or profit, you add. So gross profit is a profit on the credit side. And other income too is also coming to the credit side. So what do? We add. That is why we are adding. If you go and subtract, you are wrong. So we say add other income. Are we good? Now, there are some items we must always inspect which falls under other income. For example, we can have rent received. Whenever I see rent received or we see rent income, it goes to other income. When you see something like commission received, you see something like interest received, dividend received. When it's a sole trader, they all go to other income. Also, you can see something like discounts. This. Discounts. This. And I said a discount has 2 parts. Hey, hold on, my curves are not straight up. These are discounts. We have the discount on the debit side. We have the discount on the credit side. So now the one which comes to other income is the one on the credit side. Why? Because we are adding. And the one on the credit side is a discount which is received. So discount received is like a business, the supplier sells cartons to your business and it is costing 500 cedis. And now they said, oh, today we are doing promo. So we have reduced the price from 500 to 300. To you, the business, which has received the discount from your suppliers, have you gained money or you've lost money? Gained. It is 500. They said take it for 300. So you've gained 200. These 200 is called discount received from your suppliers. So between discount received and discount allowed, master one. Know for one that discount received is a gain. It's on the credit side. So whenever you see the discount, the one on the credit side is the received, is the gain. So if the one on the received, on the one which is the received is on the credit side is on the gain, then automatically the one on the debit side is the opposite. Are we okay?
Yes.
So we write here discount received. That's the interpretation. How much was received? 6,240. So you could see I've just written the figure right on the credit side. Why? Because the discount received is on the credit side. So I just lifted it and wrote it there. Are we okay? Are we okay?
Yes.
So discount received is on the credit side. So I'll just leave the figure and paste it there. 6,240. If there were rent received or rent income, commission received, interest income, interest received, dividend received, investment income, we write all under other income. Why are we writing them under other income? Why are we not adding them to sales? Because all these items of rent, commission, interest, dividend, and discount, the business didn't sell anything to get those things, to get those incomes. That's why they are not added to sales. They are incomes which were received in the ordinary course of business, but they are not related to the sales of goods and services, of goods in this case. Please, are we okay? So if you go and add the discount received to sales, you are wrong. Sales sold is as a result of income coming to the business as a result of sale of goods or the product. But this discount received, they didn't sell anything, but they got a discount. And it's not even a cash value, right? And we have the rent received, rent. It has nothing to do with selling and getting that income. Commission they received is not as a result of selling what they are doing to get a commission. Interest, maybe it's their investment. This dividend, maybe the sole trader has invested somewhere, they were paying dividends, then it's received it, then you add it. It's not part of the ordinary course of business. That's why we are separating them from the sales figures. All right, let's continue. Now, after discount received, we've written it down. After the discount received, we will go and check on this element, which is called allowance for doubtful debts. We will go and check on this figure against the corresponding figure in the footnote, which is the IV. So we will have a check on them. We have to check to know that was there an increase at the end of the year or a decrease at the end of the year for the allowance for doubtful debts. So what we do is this. I've said this before. Let me say it again. Allowance for doubtful debt. Please write it too. Allowance for doubtful debts. Doubtful. Let me spell it. Doubts. You are in doubt. Doubtful debts is the same as provision for doubtful debts. It is the same as allowance for receivable. Is the same as provision for receivable. They can use the words interchangeably. So you just have to know that whichever word they use is referring to the same thing. So here, we will be looking at this allowance for doubtful debts against that of the IV. Now let's look at what the IV says. First, let me write here. It says that we are looking at the allowance for doubtful debt and the trial balance. So trial balance, allowance for doubtful debts equals, what is the figure in the trial balance? 11,250. Is that correct? Is that
Yeah.
correct?
Yes.
Then this is the opening balance. I told you the trial balance information. It is either an opening balance or figures obtained during the year. But this trial balance figure, it is an opening one. The available allowance for doubtful debt. Then we go look at the footnote. The footnote takes closing balances at the end of the year figures. So when you come to the footnotes, let's look at what the footnote says. In South Zoko has a specific concerns over 5,120 of receivables. Now, when it comes to provisions, we have what is called general provision. Let me start it this way. We have the specific provision, and we have what is called general provision. We have the specific and the general. Now, the specific is always written in monetary values. The general is always given in percentage. So, whenever you see provisions or allowance in the footnotes, it could be either specific or general. In this question, it says, now Zoko has specific concerns over 5,120 of receivables balance and wishes to set up a specific provision. So specific provision with respect to these balances. So the 5,120, is it specific provision or general provision? It's specific. So 5,000, please pay attention. 120. We will add it to the general. And then the second part says the general provision on the remaining receivable should be at 5%. The general provision on the remaining receivable. So what is the remaining? Should be at 5%. Okay. So let's say 5% here. What is the receivable? What is the trade receivable? Trade receivable here. Here. I'm using yellow. This is receivable. What is the receivable figure?
124, 124, 200.
So watch. 124, 200. Watch in yellow. So for the general provision, it is 5%, which is 124, 200. Then we've taken out 5120 as specific. Do we get it? The general provision, when I say you always when you read general provision of 5%, you calculate on the receivable balance. That's the total receivables in the trial balance. So that 5% on the 124, 200, then they've taken out 5120 as specific. Are we good? The 5%, whenever you see general provision, 5%, it is 5% on the receivable, just as I did. I picked the receivables in the trial balance and I find 5% on it. That is the general. But the question is saying that they've already set out of the general, they've set 5120 as specific. Do we get it? Okay, hold on. What is the 5% on 124, 200? What? Come again? 62 what? Hold on. Let me explain it better. Hold on. It says this. Pay attention. Let me explain it better. It says, pay attention. Now Zoko has specific concerns over 5,120 of receivable balance, and we used to set up a specific provision with respect to these balances. So let me take it again. Now watch. If 5,120 is a specific provision, right? Let's take it out from the receivables. So this is the total receivables. We are taking out the specific. Let me put it this way, if you get it. Then it says that the general provision on the remaining receivable, remaining. So the original receivable is 124, 200, and we've set 5120 specific. So what is the balance? Do you get it? Okay. So the balance, and it says that it has set and I told you general provision is what? Percentage. General provision of the remaining receivable balance should be at 5%. So this remaining, when you differentiate the 5120 from the 124, 200, I mean, when you find a difference, that balance should be set at what? 5%. Are we good? Are we good? So all these we are doing, we want to find the closing balance on the provision for receivables. Then don't forget I said the names are different, but they refer to the same thing. When we find the closing balance on the provision for receivables, then we'll come and compare it against the opening balance of that same item. So here, what will be the total figure? Yes.
124 minus
So, okay, 5%. What's the 124 minus 5120? What do we have?
1,190.
Just do all together. Find the 5% on all. Do all together.
The entire total is 11074. 11074. I've added the 5120 already.
Did you all get that? Mostly, when the question says a 5% general provision, like I did initially, you just find 5% on the receivable. What's the receivable? This is what I was trying to say at first. This general provision, you find the 5% on the 5,000, 12,400, 124,200. That is the general provision. But here he says that it is 5% on the remaining balance, remaining receivable balance. So what is the receivable balance? They set 5,120 as specific. So let's take it from the receivable. When we take it out from the receivable, then we will find 5% on it. But mostly, when it is general provision and it's 5%, it's 5% on the 124,200, which is 5% on the receivable. But because they've already set a portion of the out of the 124,200, they've allocated 5,120 as specific provision. The balance remaining will be 124,200 minus 5,120, right? Which will give us 124,200 minus 5,120, which will give us 119,080. So when we add the 119,080 to the 5,120, wait. Okay, we find a 5% on it and add it together, we'll get 11,074. So it means that from what the statement says, that the remaining receivable should be adjusted. And it says the receivable balance. So we will take out the specific from. Do you understand what I'm saying? Hello? Do you get what I'm trying to say? I'm explaining. Yeah.
Okay.
So there are mostly, sometimes, some questions, it has only one provision. If they give the specific, that's what you use. So the specific is what you are going to compare with this one, with the one in the trial balance. But here they gave two provisions. They gave the general, they gave the specific. So we have to add both of them. That's what we are trying to do. If the question had given only the general, we would have just, that's what I'm saying here at the top here. The question has said it was 5%, the company allocated a 5% provision for a 5% general provision on receivables. Then we'll just multiply 5% by the receivable, which is 12,104,200 from the trial balance. And the final figure, we'll come and compare it against the one. The final figure will become the closing balance. And we'll compare it against the one in the trial balance and make our decision. But here, he gave all the two parts of the provisions. The question gave the specific and the general. So we will find the specific, which you have written as 5,120 with the question stated. And then we'll go and find the general. And I said the general is always a percentage of the receivables. So when we find both, we will add both the specific and the general together to give us the total provision at the end of the year as a closing balance. Please, do we get it? Please, do we get it?
Should I now ask?
Yeah, what's your question?
My question is, when we were solving this previously, you didn't subtract the 5,120.
Yeah, we have to subtract. We have to subtract because
512. So why did we do it that way the other time?
Yeah, but we have to subtract because please let's read what it's saying here. Where is it? Where is the okay? It says footnote IV. Now in Zoko has specific concerns over 5,120 of receivables balance and wishes to set us to set up a specific provision with respect to these balances. So this 5,120 is a receivable balance, and it wants to set this 5,120 as specific. And I've told you the difference between the specific and general is that the specific is the current, is a monetary value. It's in terms of the Ghana cedis. So that is the first one. Let me clear it again and let me resolve it so that we can get the whole concept. All right. So Lillian, I'm going to explain what your question is. I'm going to answer it. So we have the so we have here the provision. The provision we have here the provision. In this provision, we have the specific. It must be added to the general. And I said the specific is always ended in currency side. General is ended in percentage. The specific in the question is 5,120. They said that he's going to set it up. But the general, the question says, the general provision on the remaining receivable balance. So and whenever we set a provision, it is always subtracted from the receivable in the trial balance. So the receivable in the trial balance is this, 1,224,200. We want to know that it says remaining receivable balance, You could see that from the Insazo has specific concerns over 5,120 of receivables balance. Here it said just a receivable balance. And we used to set up a specific provision with respect to these balances. But the next one says the general provision on the remaining receivable balance. So how do we find the remaining? It is the 124,200 minus the 5,120. That will give us the remaining receivable balance. And we got what? Is it 119,080? Then this 119,080 says we should set 5% on it. Should be at 5%. So this remaining should be 5%. When we get a 5%, 0.05 times 119,080, we have 5,945, 5,954. We should add it to the specific. So that we add the specific to the general, we get the total provision, which is the closing balance at the end of the year. Are we good? Are we good?
Yes.
So we come here. Please pay attention. What makes this financial statement difficult is basically the adjustment, the additional information. But in exams, you are not to, if you can balance it, fine. If you can't balance it, ensure you finish everything. If you can balance it, fine. If you cannot balance, just make sure you finish the two statements. Because if an examiner is awarding marks, he will be more eligible and more willing to give a student who finished everything by couldn't balance the marks it wants to award than somebody who just did one of the statements and left. So then when you do both, let's say it's over 20. So if you're able to do all the two statements and didn't balance, it can award you about 18/20 or 17/20. But if someone does only one statement, let's say they balance the income statement or the profit or loss, which is 10 marks, and the person couldn't even finish, they couldn't balance, the examiner will give him, let's say over that income statement, the examiner will give him, let's say 7, if the person did that one. So 7/10 plus the balance sheet is also over 10, 0/10. So the person has 7/20. So the aim is you can finish everything, but it may not balance, which is better than not being able to do anything. because if in exams I'm to solve this in exams, some of the adjustments, I have to take my time and look at the figures very well and write it down. If it was under exam condition, given time, some of them you will not even have the time to think so deeply about it. You just have to finish the entry quickly and move on. So but in solving with you, I must ensure it balances. When in solving with you, I must ensure it so that we can understand the concept. My under exams conditions, some of the adjustments they can skip you. So now, what is the total? So we said that allowance for sorry, that one is called provision. The total provision for receivables. Please pay attention. How did we calculate it? We said 5120 plus 5% into bracket what? 124,200 minus 5120. This total gave us, you said, how much was it?
11074.
Gave us this figure. Then, please watch. This figure 11074, it is the closing balance in the footnote. This is from the footnote. So what we are trying to say, what led us here was because when we get to the other income, we are looking out for some items which we will post, entries we will post under the other income. Some of them, they are straightforward, like discount received, rent received, income received, investment income, commission received, dividend received. We will just write them here. They are very easy to post. But there's one which is never easy to post, and that one we have to analyze it carefully before ascertaining whether or not we post it here. And that one, which is quite difficult in ascertaining, is what we are working on, which is the allowance for doubtful debts, also known as the provision for doubtful debt, also known as the allowance for receivables, also known as the provision for receivables. And here they use two different names. They use allowance for doubtful debt and provision for receivables. And we said they are the same. So that's what we are trying to analyze here. Now, please let's proceed. At the beginning of the year, the trial balance, allowance for doubtful debt was 11,250. At the end of the year, which is the footnote item, the provision for receivables, which is the same as allowance for doubtful debts, just a change of name, was 11,074. The question I'm asking is, that 11,250 at the beginning of the year, as at the end of the year, has it increased or decreased? That same figure, has it increased or decreased? Come again. It has decreased. What is the difference? Take the lower from the higher. Now take note of this. Decrease in allowance. Decrease in allowance for receivables. Now, what allowance for doubtful debt means that at the beginning of the year, the business estimated that 11,250 cedis will not be paid. Will not be paid by debtors, those who owe the business. But as at the end of the year, that 11,250, which the business estimated will not be paid, has now reduced to 11,074. What does it mean? What it means is that the 11,250 the business estimated, some customers have come to pay their debt or portion of their debt to the tune of 176 Ghana cedis. So some customers have come to pay a portion of their debt. And as a result, has reduced the allowance for doubtful debt at the beginning of the year, which is the opening balance, which is 11,250 to 11,074. So as at the end of the year, customers who were still owing in this very year of 2020 or the year of reporting, the worth of the amount they were owing was 11,074. No more 11,250. Why? Because though they be estimated 11,250, some of the customers have come to pay 176 cedis. So it has decreased what they estimated. Please, are we okay? Are we okay?
Yes.
So this 176 is bringing money to the business. The business has gained. So what I want to say is that whenever there is a decrease in the allowance, by comparing the opening balance in the trial balance and the closing balance in the footnotes, whenever there's a decrease, it is a gain. When it's a gain, T account, where do we record gains in the T account here? Where do we record gains in the T account here? Credits. So, and we are also working on gross profit. So we come and write here, decrease in allowance. But let me show the working. 1, allowance for doubtful debts per trial balance is 11,250. Then provision. So what I've just written is allowance for doubtful debt, DD. Then provision for what? Receivables. That's how they described it. So into brackets, the 5.1, you have to show working how you got the figures, plus the 5% on the 124,200 minus 5,120, all give us 11,000 and what? Is that 74, right?
11,074.
Yeah. So taking the lower from the higher, we realize that as at the end of the year, the footnote figure at the end of the year, it has decreased by what? 176. So it's a gain. I could have done it this way. 11250 minus, then this whole thing, I write it here. They'll give me, but that will be a long process. Another thing, assuming, what if the closing balance at the end of the year was more than the opening? So still we have allowance for doubtful debts, 11250. Then the footnote, this trial balance, the footnote. You have to do this on your question paper to ascertain the decrease or increase before you go and write in the answer script. What if the footnote was provision for receivables? It was 12,000. What do you think?
12,400.
Come again?
Yes. Provision for receivable.
I'm saying, what if the provision, I'm assuming, they are not real. The second one I'm assuming, but the first one is from the question. The first one, what if the trial balance information was that it was 11,250 and the footnote was provision for doubtful that it's 12,000? What do you think? Based on what we have just done, what do you think?
It means there's an increase, which is now a less one.
It means it has increased at the end of we are looking at the closing balance. From the beginning, it was 11,250. At the end, it is now 12,000. So what's the difference? Take the lower from the higher. Okay, let me say this way. All the time, put the one in the closing balance in brackets. All the time, put it in brackets. So when you subtract and it's negative, you take it to expense. It's an increase. When you subtract and it's positive, you take it to gain as an income. Do we get it? Okay, one. Looking at the closing balance, it has increased. Now, make it 11,250 minus 12,000. What do you have? No, 11,250 minus, we are always subtracting the closing, minus 12,000.
Negative
Negative
7.
So you are going to have negative 750. Don't forget, we are looking for whether it's a gain or loss. The first one, let's look at the first one. We had 11,000 and what? 74. Let's put the closing one in brackets or jackets. So 11,250 minus 11,074. What do we have? Just take 11,250 minus the closing. What do we have?
170.
So have you seen the first one? It's positive.
Yes.
Whenever you subtract the closing balance from the opening and is positive, it's a decrease. Another way, I'm teaching you another method. So if it is positive, you just go and add it to other income. But the second one, when it's the close, you take out the closing balance, which is the negative 12,000 from the opening balance, and you get a negative figure, it is an increase. It means you take it to expense. Because we began with 11,250. At the end of the year, it is 12,000, meaning at the end of the year, it has increased. If it has increased, how we estimated that 11,250 will not be paid. What happened to the extent that at the end of the year, now 12,000 is what people haven't paid. Meaning it has increased from 11,250 to 12,000, right? Is it right?
Yes.
It means that the business has continuously sold on credit within this year. How much more have they sold on credit? 750. Am I making sense?
Yes.
The business has continuously sold on credit. How much have they sold on credit within this year? 750. That is why they estimated 11,250, or they began with 11,250. And as at the end of the year, it has increased to 12,000, meaning they've sold 750 more on credit, which when added to 11,250 will give us the 12,000 at the end of the year. So the business has lost. We are trying to gain money, but you sold more on credit. You are losing money within this year. And where do we record losses? On the debit side, just like expense. That is why when it's an increase, you send it to expense. When it's a decrease, you send it to gain, other income. Are we good? Please, are we good?
I'm too distracted.
Hello, are we good? Hello,
Yes. Hi.
are we good?
The
The rest are not saying anything. No.
They are offline.
They are Please, are we good?
Hey, Charlie, God, I beg you.
Okay. So let's add. What do you have? Add all the three. 409, 470, 62, 40, 176.
Four 15886.
41.
5886.
What is the name of this figure we just wrote?
Total income.
Total income. We got the gross profit. We added two other incomes. We added the discount received. We added a decrease in allowance. So we've gotten our total income. What is the next category of profits we have to solve for? What is the next category of profit you have to solve for?
Net profit.
Net profit or loss, right? Am I correct?
Yes.
So how do we find a net profit or loss?
It is total income minus operating expense.
So this is called total income.
Mm,
So now we will less. Why are we less in operating expenses? Because expenses are on the debit side. Total income is an income, it's on the credit side. And we will move expenses to join the credit. And when expense is crossing to the other side of the account, it is changing size, it's changing position, so it will go and subtract. Are we good? Are we good? Hey, are we paying attention?
Yes.
Yes.
So we'll say less, subtract operating expenses. Subtract operating expenses. Please pay attention. When you get to operating expenses, start from the top of the trial balance. Here. Start from here. Start from the top of the trial balance. So we start land. Is it part of, and also pay attention here. Let me explain something also here. Whilst we have Alice, where income and expenses go into the P&L statement, the remaining three, assets equals liability and capital, these three, they are used to prepare the balance sheet or profit or loss statement or the statement of profits financial position. While the P&L, which is the profit or loss, the I and E in the Alice are used to prepare the profit or loss statement. The Alice, the ALC are used to prepare the balance sheet or statement of financial position. So an item in the trial balance, if it's an asset, it doesn't come into income and expense. We don't need it there. If it's a liability, it doesn't go in there. If it's capital, it doesn't go in there. What rather we expect is that if it's an asset, the question is, what kind of expense, what kind of revenue expenditure, what kind of operating expense can we compute on the assets for that year and include it in the expenses for that year? That is what we look at. If it's a liability, what kind of expense can we compute on that liability for that year and include it in the operating expenses? If it is a capital, what kind of expense can we compute on that capital for that year, including operating expenses? But the actual asset, actual liability, actual capital, they don't feature in the P&L. They go to the balance sheet. Let me explain it further. So let's pick an example. Land, is it an asset or an expense? Is it an asset or operating expense, land? Equipment, is it an asset or an operating expense? It's an asset. But then, was there any information on the land and equipment in the footnote or additional information? Is there anything on land and equipment in additional information?
Yes.
What is
Additional
there?
information,
II, let's check what II says.
included in insurance above is amount of 18,000 paid to insure equipment.
Okay. That one is on insurance. But is there any other thing else?
No.
V. That's why I said you should. Okay,
Yeah,
I should have. You should write the footnote
depreciation
against the
is
items.
charged.
V is on what?
Land.
Depreciation.
Yeah.
Depreciation is to be charged as follows. Land, no provision, meaning don't compute any provision on land. Sorry, don't compute any depreciation on land. Do we get it?
Yeah.
Don't compute any depreciation on land. It said no provision. But on equipment, what is it? 15% reducing balance. So the equipment itself, we are not going to capture it in the P&L statement. However, we are going to capture the expense on the equipment, which is called the depreciation.
Okay.
Do you understand it?
Yeah. Don't take it again for me.
What? Come again, I didn't get what you said. The equipment is an asset. We will not capture the 2,200 equipment figure in the P&L because it's an asset, and I've explained why. That in the P&L, we take income and expenses, but equipment is an asset. Asset go to be a balance sheet. But then we would compute the expense on the equipment. We will compute the expense here on the equipment. And the expense on the equipment, which is an asset, is depreciation. That expense on the equipment, which is the periodic expense on the equipment, we will compute on the which is the depreciation. We will compute on the equipment and charge it to the P&L. But the actual 202,220, we will not write it physically there. Are we good? Okay, let's continue. So it says it should be 15% on reducing balance. So 15% on reducing balance, this is the computation. 15% times cost. What is the cost? What's the cost of the equipment? What is the cost?
202,220.
Hey, please, let's pay attention. 202,220. So 202,220. Then you subtract the corresponding accumulated depreciation. This. You subtract it, this figure. So 62,830. 62,830. Yes, what do you have? Please, let's be quick.
20908.5.
20.
90. 8.5.
And so you should make it whole number, right? So 20909. Assuming the question, please, I'm looking at different ways they can answer the question. Assuming the question said equipment, 15% straight line, or 15% on cost, or the question says equipment 15%, it doesn't write anything. So if the question says 15% on costs, or 15% straight line, or 15% nothing, you just pay the 15% and multiply by the cost of the equipment. That will be the depreciation charge. If the question says 15% on cost, 15% at cost, 15% straight line, or equipment 15%, you just multiply by the cost. Are we good? Please, are we good?
Yeah.
Hey, yo. Okay, let's continue. But here it said 15% reducing balance. So, and also assuming the question had equipment, it also had motor vehicle. And it said the motor vehicle is 15% on cost. You will just multiply the 15, or it says motor vehicle is 10% on cost. If the question had, let's say, fixtures and fittings, F&F, all these, the question gave depreciation. You compute all of the depreciation for all of them and add them together. You add them to the operating expenses. Are we good? Are we good?
Yes.
So, by here in this question, there are two assets, and of the two assets, only one has, yes,
Hello, Manuel.
I'm listening.
Can you
over the depreciation of the equipment, I'm left with the 20,220 minus 6,280, 52,830.
I don't get what you're saying.
Okay, the depreciation calculation again for him. That's what we calculated.
Can I should do what?
The depreciation on equipment.
I should explain it again.
Yes.
Okay, that's fine. Let me do it. What I'm saying is this.
Yeah.
The question says footnotes. Equipment is 15% reducing balance method. When you hear reducing balance method, write the 15%. Write the 15%. Then reducing balance means take the cost of the equipment and subtract the accumulated depreciation. When you subtract these two, it gives what is called net book value. I didn't want to explain it now. I wanted us to have gone to the balance sheet. Then I'll use the opportunity to explain how I got it. So when you hear reducing balance method, it simply means find 15% on what reduces the cost, the balance. So the balance on the equipment, this is the cost of the equipment. What reduces this cost? It is accumulated depreciation. So if this 62830 reduces the 2020, what is the balance? Find 15% on that balance. That balance is called net book value. What does a further explanation? When I said let us take note of what is called net book value. Book value means like net sales, net purchases. Net book value means the book value. The book value is the cost. Something has been taken out from it. The balance is called net book value, NBV. There's a here. Or carrying amount. Please, are you getting it? Please, do we get it?
Yes, please.
So whenever the question says reducing balance, what you must pay attention to is that it is talking about the net book value. And how do you get the net book value? Take the cost, something reduces it. The balance, reducing balance. The balance has been reduced by accumulated depreciation multiplied by 15%. And the accumulated depreciation is in the financial statements. It's here. This is the accumulated depreciation on the equipment. You subtract it from the costs. The balance is called net book value. Then you find the 15% on it. Please, are we good?
Yes, understood.
Let's proceed. And I'm saying the question could have multiple. A question could be that it could have multiple assets, not only equipment. In such a case, you have to include all of them and they would provide depreciation policy. What we have in the the V, depreciation should be a charge as well. It is called depreciation policy. So let's say that the question had motor vehicle. It had fixtures and fittings, and all of those assets, it provided depreciation policy. And it says that the motor vehicle, it is 10% on costs, or 10% at cost, or 10% straight line, or it just says 10% depreciation policy, and it said 10%. Whether it is 10% on cost, whether it's 10% straight line, or 10%, it didn't write anything, you just pick the 10% and multiply by the cost of the motor vehicle. What is the cost? Let's assume the cost is 15,000. This is how you multiply it. Here, you're going to have to be 1,500. If fixtures and fittings, it says it is 5%, and the cost of fixtures and fittings is 10,000. Then you're going to have 500. So this is the depreciation of motor vehicle. It's on cost because you multiply the percentage. This percentage is called depreciable rate. You multiply the percentage by the cost. You multiply the percentage by the cost to get this value. So at the end, the three assets in the organization, namely equipment, motor vehicle, and furniture and fittings, you've calculated the expense on the assets. That is what we will post to the P&L As I said, you will not write the equipment cost. You cannot bring the cost of the equipment in the P&L because it's an asset. And P&L, we're only considering income and expenses. So the equipment, what expense can be incurred on the equipment? That's the depreciation. So the depreciation, which is the expense, that's what we report in the P&L. And mostly it is depreciation is on reducing balance like the equipment or on costs like the motor vehicle and furniture and fittings. Please, are we good?
Yes. Well,
So the exams, I'm just speaking on the varying ways they can set it so that you wouldn't say, oh, we didn't solve. Because I think after this, anyway, we'll see what to do. So let's proceed. Okay. So what do we have next? Now, see how I began. I'm beginning from the top of it. The top of the, what's the name? So the top, I spoke on land and equipment. That what is on land and equipment that must be in the P&L. It is the depreciation, which is in the footnotes. I have computed it. Let's move on to the next. When an item in the trial balance has been written down or has been taken care of, we don't repeat it. Inventory, have we dealt with it already?
yes.
So it's not taken care of. We will leave it. Receivable and payable, they are all balance sheet items. Receivable is asset, payable is liability. VAT, value added tax refund, it is an asset, current asset, so we don't touch it. Deposits on rented premises, it is an asset, we don't touch it. Bank balances, assets, we don't touch it. Allowance for doubtful debt, we have dealt with it. But again, assuming we had the increase in allowance, which we just did here, assuming we'd have arrived at an increase in allowance here. Let's say after we analyze it, we would have come to the operating expense and would have written here increase in allowance. Then do the adjustment and written the figure here. Please, do we get it? Do we get it? Hello? Hey, do we get it? Wow, no one is saying anything. Okay.
Hello.
But because we got a decrease in allowance, we have recorded it in the under other income, so that we don't need to touch the allowance for doubtful debt again. Tax liability is a liability. Credits, it's a balance sheet item, we don't touch it. Business rent is an expense, so we will write the next operating expense to be business rent. But this business rent, there's an issue here. It says it is 30,000, but look at what has happened. Insan Zoko has agreed an annual rent of what? 40,000 with his landlord. So he has paid 30,000. He has paid 30,000 already. So if you have paid 30,000 and in the footnotes, you've agreed that 40,000 is what you pay to your landlord, do you owe or you are finished paying? Hello?
Hi.
You have paid 30,000 as your business rent. But in the footnotes, it says that you have agreed annual rent. Every year you pay 40,000. But in the trial balance, during the year, you are paying 30,000.
You are
Do
owing
you still owe
10,000.
you are finished paying?
You are owing 10.
So you are owing 10. So we say that whenever it is an accrual, please write this down. Whenever we have write this, I'm using green. So let me use pink. Let me use this. Whenever it is accrued, accrual, please write this somewhere, not in your final book. Accrued, accrual. Okay, let me write it here. Because I'll be referring to it again.
Whenever
Whenever it is, when you see the word accrued, accrual, owing, yet to be paid, pending, outstanding, so accrued, accrual, owing, yet to be paid, pending, outstanding. This is how it's treated. And this one, they are always in the footnotes. They do not come to the, or mostly they're in the footnotes. Whenever it's accrual, accrued, owing, yet to be paid, pending, outstanding, in the P&L, remember all footnote items are treated how many times? Twice. In the P&L, you add it to the related expense in the trial balance. Whenever it's accrued, I'm using equals to mean it could be, that's how they can refer to it. Accrued, accrual, owing, yet to be paid, pending, outstanding. Whenever you see such a thing related to, or you'll be able to identify such a thing related to any expense or in the footnotes, in the profit or loss statement which you are preparing, you add that figure to the related expense in the trial balance. For example, so you can see accrued utility, so there's the salaries. Then we have salaries in the trial balance. In the trial balance will be 50 cedis or 500 cedis. Then you see accrued salaries, 10 cedis. When I prepare the P&L, you add the 10 cedis to the 50 cedis in the trial balance. That's how you treat that one. All footnote items are to be treated twice. So when it comes to the balance sheet, when it's accrual, you add it to what is called the current liability, CL. So when you see anything accrued in the footnotes, in the P&L, you add it to the trial balance expense or the related expense in the trial balance. So if it is rent in the trial balance, you go and add it. If it is rent in the footnotes, which has rent in the trial balance, you only write the one in the trial balance. Then you come and write the one also in the footnotes. If it's accrual, you add it. However, if it is prepayment, you read the words prepaid. You read the word paid in advance. You read the word paid in advance. You read the word already paid. You will see that the payment is for the following year. It's for the next year. Payment for next year. For the next year. All these things tells you that it is a prepayment because we are reporting for this year and they've paid something for next year. It's a prepayment. So you have to, when you are studying the footnotes, you have to also look out for any of these. Prepayment, prepaid, paid in advance, already paid, payment for you see the payment that it was made in the next year. They are all prepayments. In the P&L, how do we treat prepayments? In the P&L, prepayments are subtracted from the related expense in the trial balance. Then in the balance sheets, prepayments are added to current assets. This two way of treating the accrual and prepayment, they are double entry. They are double entry. They are double entry. So for example, when the accrual, when we add the related accrual to the related expense in the trial balance, we are debiting it. We are debiting. Then when we go to the balance sheet and add accrual to the current liability, we are crediting. So balance, double entry has been satisfied. When we come to the prepayment section, when we subtract it from the P&L, we are crediting because P&L items are the expenses in the P&L, they are on the debit side. So if you are bringing to subtract something, it means that that figure is coming from the credit side. So we are crediting it. When we go to the balance sheet, we are adding prepayment to current assets. What it means is that when we are adding, we are debiting because assets are on the debit side. Please, are we okay? Are we okay? Don't just forget about the debit and credit and just forget about them. I'm just explaining something. The main thing you shouldn't forget about is that if it's an accrual, we add because we are owing it, so we have to add to what we have done. When we add it in the balance, the P&L, when we go to the current liabilities, we are going to write it there as owing. We are going to add it. If it is prepayment, in the P&L, we subtract because it's a gain, it's a credit. We are bringing it to the debit to subtract. So just know for the first one, accrual P&L, we add. P&L, prepayment, we subtract. Just know for only the two. Those are the two differences. But when you go to the balance sheet, we are going to add both of them. One goes to current assets, the other goes to current liability. Are we okay? I'm moving very slow. So let's go back. Business rent is 30,000. I've recorded the business rent. But there's an information on the business rent in additional information which says Insight Zorko has agreed an annual rent of 40,000 with his landlord. 40,000. So the question is, if annually in that year you have to pay 40,000 and you have paid 30,000, have you finished paying or you are owing?
You are not owing, you are still owing them ahead, but for that period you are paying.
No, at the end of it's a whole year. You are paying for the whole year. It's 40,000. But you have paid 30,000. So have you finished paying the 40,000? You are
You are still owing 10,000.
you are still owing 10,000. So he said you are owing. So accrual. So we can say that accrued, you are owing. Are we good?
Yes, yes.
So when it is an accrual, what is an accrual? What do? We add. That's why I've added the 10,000 to the 30,000. So the related expense in the trial balance is business rent. So it says when it's an accrual, add to the related expense in the trial balance. So the related expense is the business rent. So I've added. Let's move on to the next. Sales. We are on sales here. We are continuing. Sales. We have treated it already. Purchases. We have treated it already. Returns. We have dealt with them. Discount. Good. The discount, the one received is what we captured. We are left with the one on the debit side. The one on the debit side is called allowed. So here it is the business which gives the discount. So let's say Mr. Dom, as he has his business and I come around to buy something, the item costs 1,000. But because I know Mr. Dom, he'll be like, okay, man, I'll take it for 700. If Mr. Dom is reporting in his books, has he gained money or he has lost money? Has he gained money or he has lost money? Can you hear me? Hello? Hello? We are on the discount, and I'm saying we've recorded a discount received already, but the discount allowed. And I'm asking, Mr. Dom has a business. I'm a customer of the business. He knows me, I know him. I go to the business premises and an item sold for 1,000. He gives it to me at 700 cedis. In his books to Mr. Dom, has he gained money or he has lost money? I'm waiting. He has lost because an item of 7,000, he has sold it to me for 700. He has lost 3,000 because he gave me the discount. We say that he has allowed discount. So his 300, which he has lost, is called discount allowed. That is what they've written on the debit side as 4,300. So the one on the debit side is a loss. Then the opposite side, the one on the credit side, is a gain. So this is a loss. The one on the debit side is a loss. So we will record in the P&L discount allowed. It's an expense. We record losses where? On the debit side, just as expenses. And all the figures I'm writing, 20, 90, 20,909, 30,000, they are all expenses. So this one allowed to is on the debit side. Let me just copy and paste it on the debit side in the P&L. We are done with discount allowed. Then we move on to the next. Distribution and advertising is an expense. There is nothing on it in the footnote or additional information. So I will just copy and paste the figure as it is. I will not make any changes. So sometimes in exams, such figures, you can never make a mistake. That distribution and advertising is just a straightforward posting. Copy and paste. Distribution and advertising. So then write adverts and advertising. The figure there is 8,900. Copy and paste. You cannot get this one wrong. Power. It is copy and paste. It's an expense. It's on the debit side. So I'll just copy and paste it in the expenses. I'm computing expenses. Communication is an expense. Copy and paste. I cannot make a mistake for this. 1,000. Wait. I made a mistake here. Sorry. The power is 4,200. Communication is 1,540. I can never get it wrong because it's just a gracious mark given to me. I cannot make it wrong. Okay. Okay. Now, we go to the next. Insurance. So I write insurance here. What is the insurance figure? In the trial balance? 22,500.
22,500.
Is there anything on insurance in the footnotes? Is there anything on insurance in the footnotes?
Yeah, there is. I think I read it.
What is it there in the insurance in the footnotes?
They said included in insurance above is an amount of 18,000 paid to insure the equipment. The policy year ends 28 February 2021.
So that's footnotes. What comes to mind? Upon reading the footnote, what comes to mind? We are reporting in 2020 and they brought 2021 figure in. What does that tell you? I just gave you the notes. Prepayment, prepaid, paid in advance, already paid, payment for the next year is prepayment. How do we treat prepayment? Subtract from the related expense in the trial balance. In the balance sheet, add to current assets. So in the footnote, they have made a certain payment, which is for 2021 in the footnotes. And that payment, which they made it for 2021, they made it this year. It is included in this 22,500. Are you getting it?
Yeah.
Are we getting it? So we will say prepaid insurance. You have to take it out. Prepaid what? insurance. But pay attention. They paid 18,000 insurance from per what the footnote is saying. The 18,000 is for 1 year. So watch. It says that it ends on 28 February 2021. In accounting, we have what is called the accounting years we report on. We have what is called overlapping year, and we have what is called calendar year. I'll clean this. So overlapping year, what is called calendar year. I'm working on the prepaid insurance. That's why I'm explaining this. Overlapping or calendar year means that it begins on 1st of January in a particular year, let's say 2018. Then 12 months after the 1st January 2018, it will be 31st December 2018, just as it is on our calendar. When it comes to overlapping year, it will not begin in January the 1st month. It can begin in any other month. Let's say it can begin in April, 1st April of 2018. When will it end? It will end 12 months after April. So 12 months after April, will it still be in 2018?
Yes.
12 months after April.
No.
In which year will it be?
in 2019.
So watch. 29. So the year to year is what? 18 to 19. The month to month will be 4 years, but March there in 2019. The day here is first. The day there will be 31st March.
Yeah.
Do you understand it?
Yes.
That is called overlapping year in accounting. So the 28th February 2021 they gave there, it is an overlapping year. Meaning that included in insurance above is an amount of 18,000 paid to to insure the equipment. The policy year ends. So they pay the 18,000 for a year, which is an insurance policy, and it will end next month. But then we are interested in how much was paid out of the 18,000, how much was for this year. Those which are for the next year, those amounts or that amount or those monthly payments for next year, those amounts are prepaid insurance amounts. Are you getting it? Those payments for the next year, which goes into 2021, that is what we are going to compute, and we'll subtract from the total insurance to know how much was paid for this year. So it means that we are reporting in 2020, but the insurance policy ends 28 February 2021. What it means is that the overlapping year will mean that 2021, we are going backwards now. That's the first year or the year, the accounting year or the year in which the policy started was what? 2020, but it will end in 2021. We are in February. It says it will expire in 28 February. It means that in the 2020, it started in January. Is it correct? Is it correct?
Manuel, carry on.
It means that in the next, we have to understand the dating. It means that in the next year, it started somewhere in March, right? And then it will go to 28th February is the last day. So 1st March is the first day. So it means the policy is from 1st March 2020 to 28th February 2021, which will give us exactly 12 months. Are we good? Are we good?
Yes.
It says that the policy year ends 28th February 2021, which is 12 months. So if the policy year ends with 8th February 2021, which has been captured in our 2020 reporting year, it's a prepaid, because we said prepayment is when the payment is also for the next year. So we are not interested in what was paid next year to be in our report this year. We want to know this year, how much did we actually spend on? So that prepayment which you have paid for next year, which we paid in this year, which is for next year, we have to take that figure out and know how much we actually paid for the insurance this year. So out of these 12 months, from 1st March 2020 to 28th February 2021, 2 months from this 12 months belong to 2021, which are what? January and February. Is that true? Is that true?
Yes.
Hey, I'm teaching only one person. Okay, let's proceed. So 2 months out of the 12 months.
Manuel, we are all here.
Okay. 2 months out of the 12 months belong to 2021. What are the 2 months? January and February, and that is when they said it will end. So those 2 months, which are in what's the name? Which are in 2021, they are all prepayment because we only need from 1st January to 2020 to 31st December 2020. But we have paid something which belongs to 2 months in 2021 in 2020. So those 2 months we have paid is payment for the next year, and that is prepayment. And for prepayment, we must subtract it. So we have to calculate for the 2 months of the insurance we have paid and subtract it from the 22,500 in order for us to know the actual payment we made for this year, only 2020 expenditure. So the prepaid insurance will be 2 months over the 12 months times the 18,000. Then we will less it. Are we okay? Are we okay?
2 out of 12 times the 18,000 will give you 3,000.
Yeah. How much is it?
3,000.
So when you subtract 3,000,
minus
when you subtract 22,500, 3,000 from 22,500, what do we have?
19,500.
You have what?
19,500.
So it means in the whole of the year, from January to December, the business actually paid 19,500 in insurance. So the 3,000, which adds up to the 19,500 to give us 22,500, was a prepayment which was for the next year. And we don't need it for the next year. We'll just take it out. We want to know how much we actually spent this year, this 2020, the year under reporting. Are we okay? Are we okay?
Yes.
Any question?
No.
All right. Let me clean what I've just done.
Oh, the other side.
Okay, so we have 2 months out of the 12 months times 18,000. They paid 18,000 for that insurance policy. The 2 months belong to the next year. So the 2 months belong. So we only need the 2 months out. And we got 3,000. Prepayment, what do we do in the P&L when it comes to prepayment? We say when it comes to prepayment in the P&L, we subtract from the related expense. So here the related expense is insurance. So we are subtracting from the insurance. Please, are we good?
Yes.
Okay, so we are done with insurance. We are done with commission, power, distribution, discount. We are done with all of them. What's the next one? Wages and salaries. We don't have any information on wages and salaries in the additional information. So we just repeat wages and salaries. What is the figure? 164. It's an expense, debit side, copy and paste. 164,380 debit. Employers social security contribution. It is also related to salaries in the expense. Employers SNET, let me say SNET. Employer social security contribution. It is 116,560. Copy and paste. It's an expense. 4% long-term loan. Long-term loan is a liability on the credit side. It's not an expense. But we have to calculate an expense on it. The expense on the 4% long-term loan is called interest on loan or loan interest. That loan interest will be 4% multiplied by the loan amount of 182,500. Are we good? Hello, are we good?
Yes.
Wait, hold on.
Where is the written things? It's missing.
I'm using a different marker. Sorry.
Oh,
So let's go. Prepaid, right? So let's go wages and salaries. Let me write again. 164,380. Then we have employers social security contribution, which is 16,560. Then I have loan interests, which is a 4% times 182,500.
But he has wages and salary. Okay.
Yes, what do we have? Oh, please, let's be quick.
7,300.
Okay, let me see what I'll do. 7,300.
7,300.
Then we are done. We are done with the wages, salaries, employers. Now this long-term loan interest, I will not, though it's on the debit side, I will not include it in here. When we get to the balance sheet, I'll explain it. So let's move on to, it's a balance sheet item. This is a balance sheet item. Let's move on to the part.
Oh, Mengolo head no be.
2,000 plus.
So I go to the bad debt. Bad debt. What is the bad debt figure? 2,240. Another name for bad debt could be irrecoverable debt. They can use irrecoverable debt. So bad debt. Then we have drawings. We don't bring drawings. You don't record retained earnings. We don't record them. Retained earnings is an equity item. So the credit side is an equity item. Capital, equity item. Suspense, we have dealt with it. Drawings is an equity. We will deal with it when we go to the, though it's on the debit side, but we'll deal with this when we get to the balance sheet. So in all, let's see whether we have captured everything, the additional information. Inventory, closing inventory, have we captured it already? We have. In Zoko has agreed on an annual rent. The 40,000, have we treated it already? The
Yeah.
40,000, have we treated it already?
Yes, we
We
have.
have. Insurance above is an amount of 18,000 paid to insure the equipment. Have we treated the insurance already?
Yes.
Specific provision and general provision, have we treated them already?
Yeah.
Ivy.
We have.
Depreciation, have we treated them already?
Yes.
Please, that's what you'll be doing, you know. You have to be
We
confirming
have.
whether you dealt with them before you move on.
Suspense.
Suspense account balance, have you treated it already? We have. That's what you do. So it means that we have dealt with all the additional information and the trial balance information. Then we add. So we will finish it.
So I should add everything.
So add everything. 2909, 30,000, 10,000, 4,300, 8,900, 4,200, 1,540, 22,500 minus 3,000, add 164,380, add 16,560, add 22,40.
You didn't say the 7,300.
What?
289829. But contented.
Two 289829.
Correct.
2898.
29.
29.
1, 2, 3. This 289829 is the total operating expenses from the top. Is the total operating expenses. And I could have written it below here as 289829. But then for me to get the total, the net profit, what do I do? What do I have to do to operating expenses? For me to get a net profit, what do I do? I need to bring the operating expenses, which is on the debit side, match it against or align it against the total income on the credit side. And because I'm moving the debit 289829, the total operating expenses to the credit side, it will go and subtract. So what is the final figure?
126,057.
So you take it out, you take this figure out of the total income. What do you have?
126,057.
126,057. Is that correct? So this is called, is it positive or negative?
Positive.
This is called net profits. Now, we are done with the first. This is over 10. When you're able to finish this over 10, don't bother yourself so much. Do what you can. That's all. Okay. So now let's go. I said we need income and expense to prepare the P&L statement. So every expense, wherever they are, we bring them together. Having completed the profit or loss statement, we will now go and use the assets, liability, capital to prepare the balance sheet. And we know that asset has two sides, two components, non-current assets and what? Current assets. So we'll first go and prepare the non-current assets. So let's go. You go to a new page. You go to a new page. So let's say this is the first page. The second page, you write the name of the entity again. Ensa Zolco. And then we move on to the debit side. We move on to the requirement again. B says prepare statement of financial position assets. So I'll just do copy and paste without the prepare A. And I'll say statements of financial position as at 31st December 2020. Right? And I'll begin with costs. Accumulated ACC depreciation. Then I'll begin with net book value. So Ghana cedi here, Ghana cedi there, Ghana cedi there. Then I'm to find total assets. I'm using the accounting equation, the ALICE, the ALC. I'm to find the total assets. But before I can get the total assets, I must find the non-current assets. It's easy to get AO. It's very easy to get A. It's very easy. Accounting is very easy. And this is very basic. So just that the adjustments make the work difficult. The additional information makes the work difficult. Other than that, it is very basic. So let's go. Non-current assets. The first non-current asset is now land, right? Land is a non-current asset, so we write it. And the equipment is the next one. Equipment is the next. So what is the cost of land? It is 251,200. And equipment is what? 202,220. Then is there, from the trial balance, is there any accumulated depreciation on land? From the trial balance, is there any accumulated depreciation on land? No. So 25200 minus 0 will give us what? 25200. This is the net book value. You remember when we were solving for the depreciation on equipment, we said 5% into bracket, the cost minus accumulated depreciation. And I said the name is called net book value. That's what we have there. You take out the cost, you take out accumulated depreciation from the cost. Your final answer is the net book value. So it's like this: costs minus accumulated depreciation, which will give you the net book value. That's what we are doing now there. So now let's go. What is accumulated depreciation on equipment from the trial balance? Accumulated depreciation from the trial balance, what is the figure? Hey,
2909.
accumulated depreciation on equipment from the trial balance. It seems everyone is off. You let me continue.
Wait,
It is 20,000.
no. It's here, Uncle Ben. From the question.
62830.
So accumulated depreciation on the trial balance is 62. Pay attention here. Accumulated depreciation means that depreciation which has been piled up from previous years, either from the previous year or previous years. So for example, they bought the assets, let's say they bought the equipment in year 1. At the beginning of year 1, the cost of the asset was 55,000. At the end of, this is start of year 1. At the end of year 1, they said the depreciation is 40. So when they come to year 2, year 2 starts, they will say that accumulated depreciation. Year 2 starts, they will say accumulated depreciation is 40. That is the balance brought forward from year 1. Then at the end of year 2, they will also calculate another depreciation for that year. They will say that depreciation for the year is 50. So this depreciation is for the end of the year 2, and they've already brought the depreciation from year 1 as the beginning balance or opening balance for year 2. So this depreciation for at the end of year 2 will be added to that of the accumulated depreciation for year 1. How much will it now be? 90. So this 90 is a depreciation for year 1, depreciation for year 2. Therefore, it is called accumulated depreciation for 2 years. When it goes to year 3, start of year 3. When they start year 3, they will say accumulated depreciation, right? Which will be, now it's 90. We say 90 as balance brought forward. Because we are bringing this 90 from 2 years, year 1 and year 2. And we are beginning, at the beginning of the year, it's 90. Then we will look at the end of year 3. They will calculate for the depreciation for the year. Let's say that one will become 30. So at the end of the year, they will say that the total accumulated depreciation will be 90 plus 30, which will be 120. So this 120 is for year 1, year 2, year 3, accumulated depreciation. Do we get it? So this accumulated depreciation of 62,830 is from previous year's depreciation which they've added up. So at the end of the year, we will add the depreciation we charge on the equipment for this year also. We'll add it to it. So that when we take it to 2021, we will say accumulated depreciation for the previous years of 2021. So 2020, 2019, 2018, whichever date they bought the assets. So what is the depreciation on the equipment for this year? For this year, the depreciation on the equipment was how much? 20,909. Are we good? Please, are we
Yes.
good? So we come and add it here. 20,909. Then we will subtract the accumulated from the cost to get the net book value. Yeah, what do we have?
Is it plus or minus the 623?
So make it 202,220 minus into brackets
Okay.
62,830 plus 20,909.
918,481.
What do we have?
118,481.
998
No,
11
8.
eh?
118,481.
481. Please pay attention. So assuming we've had motor vehicle, we will write the cost here. Then the same thing, they will bring the accumulated depreciation like 40. Then they will say the one for this year is what? 50. You subtract the same thing. Furniture and fittings, you do all for all the three. In this question, we have only two, what's the name? Non-current assets, which are land and the equipment. So since they are the only two, we add. So the equipment, we have 453,420. Then what about the accumulated depreciation? What do we have? Eight. 759.
Eight 3739.
Okay.
That's what I go to.
Please confirm the value. I don't want to make any mistake.
83739.
You write the next one.
It's 39. It's 39. Not 59. Where do you get the 59 from? It's 739.
Okay.
So please, now watch. We spent close to 3 hours, so let's be quick. Now, when you are done, you add vertically. Then subtract the accumulated depreciation from the costs. You must have the same values, or you must have the same value. The same value in the sense that the credits, the NBV total, you add them. The cost accumulated, you must also subtract the accumulated from the cost. The figure, we must have the same figure for both sides. So someone should do the NBV side, just add them. Another person should do the cost minus the accumulated depreciation side.
MPV 369681.
369. Now, please pay attention here. Now, at the end of 2021, this is the new accumulated depreciation. Meaning, when they are preparing the trial balance for next year, 2021, at the end of 2020, this is the new accumulated depreciation, 83,739. When they are preparing the trial balance for 2021, you would see in the statement, accumulated depreciation on equipment, you see 83,739. Do not write the 62. Do you get it?
Yes.
Because when we added these two, they gave us 83,739. So only for equipment, you see this in the new trial balance for 2021. They will carry the balance and send it there. That's what it means. Okay, let's proceed. So we have 369,681. Okay. Let's proceed. So this 369,681, it is the total non-current assets. And we said that in order to, whenever we want to find the total asset, what do? We need to find the non-current assets and then find the current assets. When we finish, we add both of them to give us the total assets. So let's go and find the current assets. The current assets, we will start from the footnotes, closing inventory. So we write the closing inventory. not the opening inventory. The closing inventory, the figure is 42,390. So you write that figure. Then you write the receivable. Some they will say trade receivable, account receivable. You record it. What is it? 124,200. Then we said that in the receivable we have something on the receivable in the additional information. That is what we calculated for. That is what we calculated for. So in the receivable, what figure do we have? We have what we calculated for. And what was that? You remember what we calculated for? What was what's the name? The provision. The provision. You remember the provision?
176.
Do you remember the provision for receivables?
Yes.
We said it was what? 5120 specific plus 5%, the 124,200 minus the 5120. You just copy the same thing. So what was the figure?
11074.
Don't forget, here we don't write the gain or decrease. We just write what is in the additional information. So every figure in the additional information, it will appear in the balance sheet because they are to appear twice. Here we don't write decrease or increase. No, we just write what is there. That we are writing the closing balances. Closing balances. So if you go and write the decrease, that decrease was not a closing balance. It was just a difference. But this is the closing balance. The opening balance was 11,250, and the closing was this. Then we found a difference of 176. Here we are recording closing balances, so don't forget it. If you go and write a decrease, you are wrong. You are wrong. In fact, it will not balance in the first place. You are wrong. So the receivables, we've learned different ways they can call it. The provision will be subtracted from the receivable. So this 11,074 will subtract it. It's a provision. It's a provision. Remember, I said provision is a liability. So we are moving into the debit side. Liability is on the credit side. We are moving into the debit side. Current assets and assets, they are all on the debit side. T accounts, Alice, they are all on the debit side. Here. Current assets and assets, they are all on the debit side. T accounts. They are all current assets here, non-current assets, current assets, current liability, non-current liability. They are on all the current assets on the debit side. And we are moving provision. The provision is a liability, current. We are moving into the debit side. It will come and subtract. That is why we are subtracting it. And because it is related to what? Receivables. Another name could be doubtful debts. Provision for doubtful debt, allowance for doubtful debt. We will subtract it from receivables. Now we move to what is called the prepaid. What did we prepaid? What did the business pay in advance? What did the business pay in the next year? The business paid insurance in the footnotes. Footnote II. Footnote II. The business prepaid insurance. So prepaid insurance, how was it calculated? It was 2/12 times 18,000. We got 3,000. We added. We said that when it comes to prepayments, how do we treat prepayments? Prepayment equals prepaid, paid in advance, already paid, payment for the next year. In the P&L, subtract from the related expense in TBL, in the trial balance. Balance sheet, add to current assets. So we have added it to the current assets. What is the next one? We go with the VAT refund. The VAT refund under the receivables. So the VAT refund due. The refund due means they've not yet refunded. They are going to refund. So since they are going to refund, it is going to be part of the current asset of the organization. So 10,320. Then we are going to the deposits on rented premises. It is 17,900. They've paid in advance. It's like prepayment. It's like prepayment. They've already made deposit for their premises, 17,900. Okay, so let's go on to What is next? Okay, bank and cash balances. Bank and cash balances. How much is it? 15 is on the debit side. 15,640. You could see that all this we have not subtracted any because they are all on the debit side. They are current assets. They are current. They are debit side entries. So I'll just pick debit. Post is in debit. It's addition. Debit, post. But if I'm bringing something in which is credit, like the provision, I'll come and subtract. That's all. Let's add. What do we have? Add all the current assets. What do we have?
Bank and cash. Balance.
42,390,124,200 minus 11,074 plus 3,000 plus 10,320 plus 17,900 plus 15,640. What do we have?
202376.
Confirm.
Yes.
So when we add the non-current to the current, what do we have?
I'm coming. 239,357.
Are you adding it?
We are adding.
And you are getting what? 239.
Hey.
Adding it to 30369.
I'm coming.
572057.
2057.
Why must I add? Because for me to get an asset, back to what we are trying to do, Alice. For me to get an asset, I need to add the non-current assets to the current assets. And I add. If you're going to subtract, you are not doing accounting, you are creating your own accounting policies. Just when you find a non-current, add it to the current, add it to get a total. Are you okay? Are we okay? Hey. Okay. So 369,681. Watch. 369,681 plus what's the current assets? 202,376. 202,376. Together give, now this is the equal sign, so it will come. This is equal sign, it will come. Gives us the 572,057. 572,057 equals. Now we are left with the liabilities and capital. Let's go and find the capital first. So I come here and I write. So this here is called total assets. I've added 2 assets. So the next one is, I'll say capital and liabilities. Capital and liabilities. Let us go to the trial balance. What's the capital value? Capital.
103,710.
103.
710.
Please don't forget to double underline. Double underline the figure. Don't leave it. Don't just underline it once. Double underline it. Give it two lines. It means you've closed it. So 103,710. Then we'll bring the net profits from the P&L. Net profits. What's the figure from the net profits? 126 and 57. 126 and 57. We'll add it. If it were a loss, you subtract it. Then we'll bring the drawings. What is the drawings figure in the trial balance? Hey, hold on. There's something I've been brought. Hold on. Watch this. So these items, retained earnings will go to the capital. After capital, I'll write retained earnings. Retained earnings is an equity item. How much is it? 44. It's on the credit side. Capital and liabilities, they're on the credit side. 44,820. Then I'll bring the net profit. What's the net profit figure?
Net profit.
1, 2.
1,260,57.
1,260,57. Then we come in. We bring drawings. What's the drawings figure? 10,000. So you can see, look at capital. It's on the credit side. Retained earnings, credit side. Net profits, credit side. Then I'm bringing in drawings. Where is drawings? Is it the debit or credit side?
Drawings is on. What is it? Credits. Oh,
I just want you to understand it. This is it. Drawings, look at drawings. Which side is it? On which side of the account is drawings? Is it on the debit or credit side? It's credit.
hey, debit.
It's debit. So if drawings on debit side, I am moving it to credit side. Will it add or subtract?
Subtract.
So you go and subtract it there. Because all the figures are written there, they are all credit side items. Capital is credit, retained earnings is credit, net profit is credit. What's the final figure?
A minute. Two 64007.
264.
007.
Right? So we are done with the capital. So watch. The capital here is the C. 264,007. What am I left with? The liabilities. But the liabilities, they have two parts. They have the NCL and the what? CL. Before I'll add the capital. So let me go and find a non-current liability. The liability, non-current liability.
Hello.
Non-current liability. What is the non-current liability in this question? It is a 4% long-term loan. So they can bring debenture, they can bring bond. 4% long-term loan. You write the entire figure. You will see that in the balance sheet, I'm using the total figures as they are. I'm not dividing anything by anything. I'm just writing the figures. That's why we say that some items, they are balance sheet items. They will not reflect in the P&L. But we only calculate the expense of them. Like the long-term loan, the expense on it is the loan interest, which we calculated. The equipment, the expense on it is the depreciation. But we will not write the absolute figure there, the physical figure, we will not write it there physically. But here you can see that I've written long-term loan, the entire figure. Okay. So this is the only long-term loan. The next is that I'm following the accounting equation. That's why I come back here. So I'm done with the NCL. The NCL's figure is what? 182,500 plus the current liability. I'm done. I have a lot of other things. I have to get to this and other things. So current liability. Current liability, the first thing you write is the payables. Payables figure, how much is it?
Payables is 104,350. Abi?
Payable, watch.
104,350.
That's payables figure. Payables is 104 350. Then afterward, we will go to everything which was accrual. Okay, let's go to the trial balance. We had tax liability. So tax liability. The tax liability was it was on the credit side. So you can see it's on the credit side. 7420. There's a liability. So we bring it to current liability. Then we bring in every other thing which was okay. Let's look at the loan interest. So you could see we had loan interest paid here. And I told you we will attend to it. This loan interest figure, this. So when we calculated for the 10% on the loan interest, what did we arrive at? When we calculated for the 10% in the P&L, we calculated for 10% loan interest. This figure got 7,300. So
Was it 10
remember,
or
why are
12?
we adding it here? We added the loan interest because as at the end of the year, it is deemed as a provision, an outstanding, or as an accrual. So we will add it there. Then when we come to the current liability too, we would introduce the money back. So the loan interest will come here. At 10%. 10% on the 182,500. That 10%. We will introduce it here. We are going to have 18250. 18,250. We will bring that loan back. Please pay attention. Then the long-term loan interest, the one on the debit side, we'll write it here. Long-term loan interest. How much was it? 3,520. We will subtract it. What it means is that the loan interest, you know, the question didn't speak about loan interest, but I'm repeating it here. I'm repeating it here because, hey, please watch. It is not 10%, it's 4%. The loan interest is 4%.
I was about to ask, but you didn't respond.
Oh, sorry. It's 4%. So 4% on the 18,250, what do we have? 4% on 182,500. What do we have?
7,003. 7,003.
Is the same as is in the P&L. I'm saying that the question never made mention of the loan interest in the additional information. But you see, I've treated it twice. It's in the P&L, it's here. So whenever you see long-term loan, that's how you treat it. You treat it twice, in the P&L and in the current liability. And also we have long-term loan interest. Some trial balance, it will be written interest paid. So it means that the business at the end of the year will owe. You went for a loan. The loan is 4% per annum. So every year, how much interest will you pay? 7,300. So since it's at the end of the year, it's an additional information matter. Since it's at the end of the year, it's a footnote matter. So figures at the end of the footnote or additional information are accruals, right? Or prepayment. So this loan interest is assumed to be at the end of the year, which is true. And the 7,300 is an accrual. That's why I added it in the P&L. And here too, how do we treat accruals? What is the double entry rule for accruals? We said that for accruals, which is the same as accrual yet to be paid pending outstanding footnote item, we add it to the related expense in the trial balance. And in the balance sheet, add it to the current liability. That is why I added it to the current liability, the loan interest, the 4%. Then the long-term loan interest means that though the business knows that they will owe 7,300, they've already paid 3,520. Do you understand it? So I know I'm owing 7,300. Then during the year, I've paid 3,520. So the balance owing is 7,300 minus 3,520. That's the balance. Are we okay?
Yes.
All right. So that's a long-term loan interest. That's a long-term loan interest. Let's see whether there is any other thing. We also had accrued rents, II, footnote II. And Sam Zoko has agreed on an annual rate of 40,000 meters.
Oh my God.
Meanwhile, he has paid 30,000. So how much was he owing? All the accruals in the P&L, we will bring them down here to current liability. So we have accrued rents. The accrued rent, how much did we record it in the P&L? In the P&L, we recorded it at an amount of 10,000 here. Do we see it? Do we see it? Accrued rent is 10,000. So the accrued rent, you have to treat it twice. We go to the current liability, we write accrued rent, we write the 10,000. How did we come by the 10,000? It was the 40,000 minus the 30,000. That is all. I think we are done with everything. So add everything. Let's see how much we will have.
One, 2, 5, 5, 5, 0.
1, 2, 5, 5, 5, 0. So add. So watch. Look at what I'm doing. Oh, watch. So here, back to what we were doing. So the non-current liability is 182,500, and the current liability is what? What's the figure for the current liability? Current liabilities figure is 1,2,550. So 1,2,550. Add all these three and give me the total. That is what I'm doing here. I'm adding the capital. I'm adding the non-current liability and the current liability. Then I write the total down here.
All the three.
Yeah.
Oh, I can't see.
264,007, 182,500, 125,550.
572057.
Come again.
572057.
Is it the same as what we saw for?
Yes.
So 572057. That's the answer. So you see that we say it has balanced because in the T account, watch, in the T account, Alice, we've taken income and expense to repair P&L. But then we are left with what? We have Alice here. We have the ALC. We've taken the I and E are out. We've taken them to repair income statement. So the Alice, the debit side is 572 and 57. And the credit side, when we add all the liabilities and the capital, we also have what? 572 and 57. So it has balanced. The debit and credit side are the same. That is what we mean by balance their work. They should be the same. So here, we said capital and liabilities. So all the things beneath the capital and liabilities fall under capital and liabilities. Therefore, the final figure here, we will say total capital and liabilities. That's it. Our work is balanced. So let's verify whether the additional information items, we treated them twice, like we said it should be. Let's verify whether they were all treated twice. So let's start. Inventory, 42,390. Were they treated twice? It's here. There's a balance sheet. It is here. Let's go to the closing, the P&L. Inventory 42,390. Let's see whether we see it there. It is also here. So it has been treated twice. Then you mark it. In South Opas agreed on an annual rent of 40,000. The annual rent, the 40,000. Let's see whether we treated it twice. Annual rent, the 40,000 is here. The main concept there was the accrual. The accrual is there, 10,000. So this is the P&L. Let's check the balance sheet, whether it is also there. The 40,000 accrual will go to the current liabilities. So the 40,000 is here. The 10,000 is there twice. We are done. Included in insurance above is an amount of 18,000 paid to insure the equipment. The policy year ends 2021. So payment in the next year is a prepayment. So we have prepaid insurance. It is here, 18,000. We got 3,000 here. We added it. So let's go to the balance sheet and see, the P&L, whether we have any prepaid insurance. Prepaid insurance, the same thing, 3,000. It has been treated. In South has specific concerns about 512 provisions. So the provisions, let's check the P&L, whether the provisions were in there. So this is the balance sheet. The provisions figure is here, 11,074. Let's check the P&L, whether it was there. P&L 2 is here, 11,074. So we are done. Let's get the last one and we should move on. Depreciation. Land had no depreciation, but equipment had depreciation. So depreciation, let's see. Depreciation, land had no depreciation, equipment had. This is equipment's depreciation. Land had nothing. So we go to the balance sheet. That figure of 2909, was it in the balance sheet also? Yes, it is there. Cost accumulated depreciation, 2909, treated twice. The VI, the suspense account balance about related to sales of 1,000, which was received in which was recorded in purchases. It should be treated twice. Let's see whether it was treated twice. So here it was an adjustment affecting the purchases. But let's see. So this 1,600 added. It was subtracted here. Is it in the P&L? Is it in the financial position? Yes, it is there. Where can we find it? It is in the net profits. It is in the net, it's an adjustment, so it is in the net profits. So there was one which was not stated, but it was treated twice, and that was the loan interest. So whenever you see a loan, though they may not state in the footnotes, you must know you have to treat it twice. It will be in the P&L to come to the balance sheet, and you less the loan interest paid. Are we okay? Hello, are we okay?
Yeah.